Hi all, this is Manjit from Alpha Capital, and in today's video I will be talking about the biases, the psychological, the cognitive biases which we humans have. How do they impact our financial and general life decisions? Hope you'll find this interesting. And in the recent years, we have seen many financial experts, many economists writing papers, writing novels on this topic, and even won Nobel Prize. And the topics of behavioral finance and behavioral economics has picked up a lot of traction in the last few years, if I would say. And although there are many more biases, but I would be covering the 6 key biases in this video. And let's start. So the first on the list is the confirmation bias. This is basically once we made some decision or we made some investments in a real estate or a stock, we start looking for more and more information, more news, which is confirming to the stance or to the decision which we've already made. And we tend to overlook any negative news or information which is not related to or opposite to the decision which you have taken, and which can actually lead to some kind of loss. So we all have this bias, and the only way to overcome is to think about certain possibilities or probabilities of why your decision could be wrong, and then to have a broader view. And the second one on the list is the recency bias. The recency bias is more about we as individuals, we tend to make decisions based on the recent information or recent events which we have seen around. And investment worlds, you would have seen people investing into equities or other products based on the recent returns, last 3 months or last 6 months return. And they expect similar kind of returns in the coming months, rather than looking at a 3-year to 5-year performance of equity. So we all have seen this bias in our decisions, and the counter to this is to build a long-term view and look at the long-term returns and the trend of the product or that investment rather than looking at a recent update. The third bias is around the loss aversion bias. The loss aversion bias is basically once you've invested into a product, right, you tend to not book loss and to end up in a situation where you actually are gaining something, right? So, and as a result, what happens is you keep on averaging, even though we know the product prices is going down or the NAVs are going down, but we keep on investing in it and just to average it out and avoid any kind of losses. And as a result, what happens is there's an opportunity cost which you suffer where you could have actually exited from the investment and got into another product with much higher returns. So that's loss aversion bias. Then the fourth bias is around the anchoring bias. The anchoring bias basically talks of when you look at a number or a data, you try to anchor your expectation from could be from the another investment basis that number data which you've recently seen. So it could be like if you see the returns of a stock of last 6 months about 50% or 30%, then you start expecting similar returns from another stock of a similar company which you want to enter. But at the same time, if you look at the interest rates of FDs, which is around 6%, 7%, and then with that, after seeing the interest rates, if you go and you invest into product, your expectations would be around similar 7 to plus minus 2% kind of return. So it's basically the numbers and data which you see, you tend to make anchor around that for your expectations. So that's anchoring bias. And similar is your framing bias. Framing bias is basically depending on how the data is presented to you, you end up making your expectations and view about that investment. So, for example, if someone shows you the returns of a small cap fund for last 1 year, you would see this quite a few funds would have given a negative return. Then you start believing that small caps is there's a high probability of getting a negative returns if you get into those funds. But if you look at the small cap fund returns from a 3-year perspective or a 4-year perspective, you will see almost all of them given a positive returns, and positive returns in 20% plus kind of a bracket. So your perception, your framing would change to a positive returns from a small cap investment. That's about the framing. That's depending on how the data is presented to you. You tend to build your view around that. Now, the last bias I want to talk about is the herding effect or the bandwagon effect, which is basically you tend to invest into products. You tend to get into those investments where you see most of your friends or most of the public is investing into, without having the right knowledge and done the right kind of research to actually get into those products. So, and we have seen that in the past in .com bubble where everyone invested into technology stocks and they ended up losing quite a bit of money. And this is basically more because of the FOMO, which is like the fear of missing out, and more to do with the emotion because of which you invest, where you see most of the people investing and don't want to lose the rally. So these were the key 6 biases I wanted to talk on this video, and I really hope that you could actually think through them, really relate to certain your life incidents where these biases would have played a role in your decisions. And as humans, we cannot get away with these biases, but definitely a knowledge about these biases can help us in making a better, more rational and informed decisions. So thank you. Thanks for your time. I hope you enjoyed this video and I look forward to see you soon. Thank you.